You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Okay, so a lot to talk about interest rates today. And I think we're going to hear a lot about it tomorrow and all next week. So the Fed announced they're cutting the interest rate by not 0.25%, but 0.5%, as I'm sure you've already heard. And there's a lot of hubbub about it. People were expecting it. I think before the notification, about half of those were thinking for 0.25 point, and there were about half who were thinking about 0.5 point. My personal feeling, I felt that 0.5 was a little too excessive. I don't even know if I was in favor of a rate cut at all. I was kind of hoping, let the plane land, but I could understand 0.25. It helps with the mindset, which I'm a big advocate of, trying to get your mindset in the right place. And when you're trying to get a whole nation and then a world, in a sense, because a lot of the world looks to what goes on in the United States, I could get my head around 0.25%. I could understand the 0.25%, even though I'm not a huge fan of cheap money. I think a lot of cheap money for a long period of time has created some of the problems that we're in right now. But I was surprised, to be honest, about the half a percentage point. And I was also surprised at the 0.5 percentage point this close to the election. I'm not going to tip my hat. This is not a political podcast, at least not yet. Hopefully I don't get drug into it having to be a political podcast at some point in time. But it does seem like everything is politics, and politics is everything these days. So, but we'll save that for another podcast. This is a podcast about home building and all things home building and all things that impact home building. So back to the interest rates. So the interesting thing about interest rates, and Ali Wolf posted on LinkedIn about this, essentially the mortgage rates were predicting this. And so in the last week, if you notice last week, I think it was 0.18% drop in the 30-year rate. And so I don't expect to see a whole lot of movement in mortgage rates in the near future. And when I say a whole lot, I'm not an economist, definitely not a macroeconomist, and I'm definitely not, a finance guru by any stretch. I'm just a home builder. But maybe another 0.25 point reduction in actual mortgage rates between now and the end of the year, but I don't expect much more than that. And but as Ali so aptly pointed out, that the markets have already kind of priced this in. I think the FHA 30-year fixed rate right now is at about 6.08, and I believe the traditional 30-year fixed rate is 6. Don't quote me on this. It's closer to 6.8, 6.9. And so what's interesting there is, it seems to me that most of the news outlets, when they report the rate, they always go to the FHA, which is interesting because I was at a client's office the other day, and they were talking about setting up new communities, and when you do new communities, you have to set up HOAs and CC&Rs and all these docs for to get prepared for selling, and it's a bit more onerous for home builders to do FHA loans than it is conventional. Not quite as onerous as VA loans, but a lot of hoops and things that you've got to jump through, and so there's rules and regulations and things that you have to have your house meet. So but either here nor there, I think it's interesting that most of the news outlets that I read, when they put the 30-year rate, they're putting the FHA, and so I just want to make sure everybody's kind of clear on that from what I see, and just look into that and read into that. And there's pros and cons to FHA, and so just keep that in mind. And so anyways, Ali pointed out that was already pretty well priced in. I think it was a 0.18% drop in mortgage rates already last week to get to that point. And so there's a ton of talk about what does this mean for buyer affordability. As I mentioned, this is a home builder podcast, so I tend to think about things from a new home construction perspective, new home sales perspective. So, but for a moment, I'll go to the resale, because in my opinion, when you look at the rates and what's happening with the rates and how that's going to impact things, you have to look at it. It's a tale of two cities. The city of existing homes and the city of new homes. Why do I say that? Because let's start with the existing homes. So on the existing home side, first off, there's a fair amount of refinances that are going on because there are some people who had to buy, back in late 2022, early 2023, who have loans, let's say in the upper above 7.5. And so if you can refinance today from, let's say, 7.5 to 6.25, that 1.25% reduction can be huge on your monthly payment. So the refi, industry is getting a nice little uptick from this, which is, good for them. We need them to be around. We need the mortgage industry to have that. It's a big part of their business. And we need that for them so they can stick around and they can, be profitable. And so resale inventory, existing home sale inventory, you're going to see some refinancing. And I think you'll potentially see an uptick in sales, which, be careful, and we'll talk about this maybe next week. There's a lot of talk about the August sales data, and once again, you gotta parse that into new versus used or existing. And so I think that we're not in the good buying season right now, right? We're rolling into the end of September. People with families, their kids are in school, schools have started. That's not the best time to move a house. Even if you're staying within the same school district, it's just a lot of upheaval. And then holidays. So it might help the resale market a little bit, but that will probably get drowned out by the softer sales that come seasonality wise from this perspective. But the Fed has talked about continuing to lower rates, and I think we're probably going to see at least one, if not two more quarter point reductions from the Fed between now and the end of the year. And we'll see. He's trying to land the plane, and we'll see if he can do it. If it's a softer landing or a bumpy landing. So I think that might help. Like I said, that might help. That's going to help refinancing. That's definite. Will it help the existing home sales? It may. The reports just came out like that August sales were off, and once again, clickbait on the news. They love to speak about the negative more than the positive, but they just like headlines that are going to attract attention. So the sales weren't that off of what was predicted, but so it'll help refinances. It'll probably help resales for the fourth quarter, but remember, it's also going to be drowned out by the seasonality things. Now let's get to the new homes, because that's what this podcast is all about. We talk about all things home builder, new home construction. So affordability. Here's the interesting thing, and this is just my opinion, but I'm going to say here's what I think is going to happen. Most home builders, definitely publics, and what I call the larger privates. And when I say larger privates, what I consider public home builders, production home builders. To me, if you're building and selling and closing more than, I like to say 100, but even a lot doing 50, if you're doing, let's say 100 homes a year, you have already been doing some form of mortgage buy down. And if you look at what some of the builders are doing, the large builders are easy because they have big websites, and you go to their websites and you can see what they're advertising. For since at least, let's say, the last year, if not the last year and a half, the large builders have already been buying down mortgage rates to help keep their sales going. And it's not uncommon to see an advertised mortgage rate of a 4.99 fixed rate mortgage. They have the capital and the ability to go out and they buy debt that they can use to finance or provide lower cost financing for their home buyers. And they've been doing it because it's become a cost of doing business. It can cost home builders anywhere from $25,000 to $50,000, depending upon the market they're in, the credit score of the buyer, the cost of the home, or the sell price of the home, to get that rate down to 4.99. But I have consistently seen 4.99% and sometimes even 4.5% advertised. But let's put this all back into context now. If 1 year ago rates were closer to 7% FHAs, and now they're closer to 6%, and just as a hypothetical example, and as a builder, you have been spending $20,000, $30,000, $40,000 to buy the rates down from close to 7 to close to 5. right now the going rate of the going mortgage rates are still higher than what the builders have been buying the rates down for. So the question in my mind becomes this as it relates to the new home market. Will builders continue to find ways and figure out ways and leverage the same amount of money they've been using as a cost doing business to buy rates down, to get rates down closer to 4%? Or will they stay consistent at keeping those rates down to 5%? And then their cost to get that rate down to 5% is going to go down significantly, thereby lowering their cost of selling those homes, which will relate to improved profitability for the home builders. So that's the big question. And so only time will tell. My gut tells me that it's dependent upon this. If their home sales stay relatively consistent with what they think it should be seasonally, because as we said, home sales typically across the board go down this time of year. So I predict that if home sales stay the same, with the mortgage rates being bought down to about 5% by the home builders, that they'll just keep doing that. And the savings that they will reap from being able to only have to buy that down from, say, 6 or 6.25 to 5, rather than 7.25 to 5, that's just it's gonna be a good thing for the home builders, because they're gonna have less money that they'll need to spend to get those mortgage rates down. So, but I think we're gonna stay in that window of time now, because we expect sales to soften as we go into October, November, December, as we've talked about in the past. The year is sold, or let me phrase that. This is sometimes when I just kind of talk about these things, I think about some other things that could happen. So the year is not sold. The year is started, and we talked about that after the July negative starts that everybody's making a big deal about. But so if builders get pressured to make deals because they have to make sales to make their closing number, so, builders start homes and they're not all sold, there might be a push for them to increase their incentives to get that mortgage rate down from 5 to 4.5, maybe even to 4, and continue to use the same amount of money that they have been using to push that down to get their sales number and their sales pace. So it's going to be interesting to see what happens. And there's a few large builders who are in many of the markets who tend to lead the way. I won't, mention any names in particular, but if you just go look at the top 5 home builders in the country and you kind of watch what they do, they sort of force others to follow what they do. So my general thought earlier today was that they're just going to take the money, keep buying the rates down to 5%, and they'll just keep doing what they've been doing, and then maybe instead of $50,000, it's $25,000, let's say, and then they get to keep that extra 25 grand. But the more I think about it, some builders may be in a crunch to get the number of sales they need between now and the end of the year, and with let's call it a 45-day close, safety close, with the holidays, you really want to get, if you're a year-end builder, if your year ends the fiscal year December 31st, it's hard, unless it's a cash buyer, if you sell a home after the 15th of November, to even get that as a closing for this year. So I think we're looking at the next 2 months to watch the sales pace of the big builders and see if they're getting the sales that they want. I'm inclined to think that they are, and they will. I'm inclined to think that they'll use that $25,000 or whatever that is as kind of back pocket money, and they'll do a little trading of things. They can do incentives like washers and dryers and refrigerators to boost up their sales. Because I think if they start to push that rate down, that they lose flexibility as we go into the next year. If builders start to consistently buy rates down, say to 4.5%, I believe they're stuck doing it for the long term. Whereas if they do incentives like, give option credits or discounts like that through the year end, they can make those holiday sales, and they can do those things to incentivize buyers, keep the rate at 5%. And I think 5% rates right now are considered acceptable. From a mindset perspective, I bring this up is, in September of 2018, interest rates hit 5% for the first time in a very, very long time. And we nearly shut the sales off because millennials were just starting to come into the market. And from the millennials' mindset perspective, that was the highest interest rates had ever been. And their mindset was that they'll never get they'll never get higher. They're only going to get lower. So they stopped buying in anticipation that the rates would come down. The rates eventually did come down for probably more for political reasons than anything else. But that's neither here nor there. And then COVID, and a couple years later, and they continued to come down. And so what's interesting though is if you look at that happened in 2018. Then we took rates down. Then when rates came to 5% again, as we started to raise rates, we didn't really see a softening of sales at that point. So that's what I mean by the mindset shift. The second time we got to 5% and we were climbing, the millennials who were already into the market at the lower, kind of at the lower numbers, they had seen 5% already, so it wasn't a shock to them or a shock to their system. Now I think as we're at 7%, now it's really more just a driver of affordability. And I think everybody's accepted the fact that I was talking to somebody today, we're saying sub 4 are a thing of the past. I think true sub 5. I don't think that we'll see an FHA 30-year fixed below 5% for the foreseeable future. Even if the Fed, does continued, rate reductions throughout 2025, I think we'll maybe get close to 5. But, and I don't think that's horrible. We're selling homes right now with builders buying them down to 5%. And so the market has proven that at 5%, things will go well. So we just have to watch what happens between now and the end of the year. And do the sellers, the builders, do they start to push those rates below 5, really below 4.5 and kind of down closer to 4? If they do that, then they're reallocating the fund savings that they're getting from the rates coming down to continue to push the rates down. I did hear an inkling of this coming in another market in Florida. I saw a post online where someone had said that he kind of started to see that. I don't think that's going to be systemic throughout the industry, but I could be wrong. So I think we're going to see builders kind of hold that savings, that buy down savings close to the vest. I see they'll use it strategically for the end of the year with, kind of year-end holiday sales. They do these all the time. D.R. Horton, I think this coming up soon, they'll do their red tag sale. They'll use that money to, to fund those red tag sales, move-in closing packages that, builders like to do this time of year, included washer and dryer, refrigerator, window coverings, etc. I think we're going to see builders do that. I think we're going to see builders keep that bought down interest rate in the 5%. They're getting comfortable with it. The buyers are comfortable with it. I just think it's interesting that when rates come down, everybody gets excited, and we think that that's going to increase buying power, and it does on the resale side. That is for sure. And so that could create a whole other different scenario and pressure in terms of a little bit more competition for new home on the resale side. But there's still a 1% gap, which does create an affordability issue. So, but it could lessen the gap a little bit if you're in a crunch and you need to move quickly. So I think the builder's going to hold that money close to the vest and use it strategically in different ways, but I could be wrong. We'll just have to see. Time will tell the next 60 days, as we said, between now and when they're done selling the homes they need to sell to close in 2024. And then we'll just have to continue to watch the interest rates. Like I said, I don't see interest rates, maybe kind of slowly coming down a tenth, a quarter here or there. Maybe by the end of next year, they start to make their way down closer to, 5.5 or maybe sub 5.5. I think that's about where they go. But, is this a good thing? Is this a bad thing? You're going to read a lot about affordability. If my opinion is correct and builders keep that rate at 5 and don't go further, the point I was trying to make with this whole thing was, it doesn't really change affordability for the buyer. They're already getting these buy downs from the large builders and the production builders to get to that place. So if they don't redeploy that money, the builders don't redeploy that money to push that rate down even further, it really doesn't do anything for affordability for the home buyers. So we'll have to see how that goes. And yeah, so hopefully you enjoyed this episode. Really appreciate everybody. Just got back from the biz. As you can see, I'm filming from a different location. So I was trying to get a standard location, but now I'm 3 locations for 3 episodes. It's been a busy week of travel the past 7 days, and I just got done at the Building Industry Association of Southern California's Biz Show. And it was a great turnout. It was a really fun event at Pechanga Casino in Temecula, California. Had great conversations with lots of builders and trade partners. I think cautious optimism is what I would term the sentiment that I hear. And hopefully we continue to see just this steady pace. And thank you again for tuning in and listening. And if you are so inclined, I've been loading the episode 1 and 2 to YouTube, and I'll make sure I'll be including those links going forward. And we'll talk to you again next week. As always, if you've got any thoughts for things you want me to research, discuss, or talk about, all things new home construction, put it in the comments below, either on LinkedIn when I post this there, or on the show note comments, wherever. Send me an email, let us know, miked@amazingmindsets.co. We'd love to hear from you, and we really appreciate. And thank you to the few folks who came up to me at Biz today and said they were really enjoying the show and said that it was very well produced. I was surprised because, I said anything is better than nothing, so I just wanted to get this started. So a little bit of software, a little bit of help from my virtual assistant, and we're bringing it to you. And we're going to hopefully continue to bring it to you every week and continue, because I love talking about home building, all things new home building. And we'll talk to you soon. Have a great day. Have an amazing day. Thanks for listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Remember, your mindset matters,